631 billion US dollars of assets under management is a good start. And it's quite a wide spread of assets that we invest in. About a quarter of that 631 billion is in equities, about a quarter is in fixed income, about a quarter of it is in private markets, including real estate, and the other quarter is in other alternative investments. And the growing part really is a mixture of all of those assets that I've mentioned before in what they call multi-asset. There are certainly bigger fund managers around, people like BlackRock, Vanguard, Blackstone, but they concentrate in one area of the market. BlackRock and Vanguard in passive investing, whereas we do have a small passive area of our business, but we're trying to offer as many in-house strategies to meet the requirements of our clients. So that's Aberdeen. If we go on to the next slide, Dominic, we just look at Aberdeen in Malaysia. We've been in Malaysia since 2005, that's 17 years, although we've been investing in Malaysia for nearer 40. We started investing in Malaysia in 1983 from our UK office. We were awarded an Islamic license in 2009, and Malaysia is the Islamic hub for Aberdeen Group. We manage a total in Malaysia of $5 billion US dollars, 1 billion of which is Sharia compliant or Islamic, and consists of equities, sukuk, real estate, and multi-asset, Sharia multi-asset strategies. We started with 6 people back in 2005. That's 5 Malaysians and 1 Guailo or Matsale or White Honky. We're now at 18 people. Still just the 1 Guailo, which I think is highly racist, and the rest is a mixture of other Malaysians. So that's really us. We have a decentralized office here, and we run all the Islamic funds from here, although for the Islamic World Equity Fund, we have a specialist team of 14 fund managers in Edinburgh who select the model portfolio, although regulated here in Malaysia. On the next slide, in short, we are bottom-up, long-term, stock-picking investors. We spend most of our costs having people visiting companies all over the world, whether they're sukuk, equities, real estate, other forms of investment. So we are constantly in touch with the companies that we visit. We're visiting thousands of companies every year. And the key thing, I think, that the new Aberdeen has really emphasized, and our mantra is we get it done together. We work as a team. It's a very competitive industry, fund management. Margins are narrowing, costs are rising, but to have an edge, you have all to take advantage of what you have in-house. And we're particularly lucky to have that. And I think more than ever, each client might have different objectives, and we are trying to adjust our portfolio managers and adjust our funds to meet the objectives of our client. So that's it in a nutshell, Jason, about what Aberdeen's about.
Thanks, Jerry. I understand that Sharia investment solutions, they have been proliferating due to fast growing demand in recent years. However, it's still a rather niche and underserved area when compared to conventional solutions. Perhaps you could share with our viewers what Sharia investing is and how is it similar or different compared to conventional options. Also, what are the benefits of having a Sharia-compliant portfolio?
Okay, good question, Jason. Thank you. If we look at the next slide, we're trying to debunk some of the misconceptions about Sharia-compliant investing. I think one of the first one is, I'm not allowed to invest in Sharia-compliant investment. I'm not a Muslim. Well, it's really just a form of investing that is a useful tool for anybody who wants to invest ethically. The basic premise, as mentioned in the first point here, is to invest in businesses that are socially responsible. And we do avoid, well, Islamic rules prevent us from investing in companies with a lot of borrowings, or in fact, too much cash, more than sort of 35% of the market cap of a company is in cash, it becomes uninvestable. So we're guided by our Sharia advisors and by the index provider who provides our benchmarks to stay within these checks and balances. Another complaint is that Sharia options are too restricted. They're too small. You can't really get your a proper diversification when investing in Sharia indices. That may be the case if you invest in Papua New Guinea Sharia equities, but if you're investing in global equities, MSCI, Dow Jones, I think we use MSCI as our Islamic World Index, has thousands of stocks with tens of trillions of dollars of market capitalization with ample liquidity. The size of Aberdeen Standard Islamic World Equity Fund at the moment is just over 500 million ringgit, but the liquidity can be liquidated within 3 or 4 days, but certainly 10% can be liquidated in the space of an hour. So there's plenty of choices, but the forbidden sectors remain. That's basically you're not under Islamic principles allowed to invest in alcohol, gambling, weapons, tobacco, adult entertainment. Another complaint, I think, is that it only benefits Muslims. It doesn't benefit anybody else. But actually, Islamic investing, according to the World Bank, has emerged as a very effective tool for financing worldwide development for everybody, including in non-Muslim countries. I think about 6% of the UK is a population, nearer 4% is Muslim, but they have their own Islamic debt securities, which is used for social financing. So it's really for everybody. And the key thing about Islamic investing is there must be a proper asset behind it. You can't shroud it in mystery and calling it different names without actually letting on to the investors what's behind it and what creates the income. So in a way, it offers some form of seal of approval that if it's Sharia compliant, there is real assets throwing off real income behind it. What Sharia investing is not is another. There are several myths that can be debunked, and what is that? There's no profit from it. Well, I think you can say quite comfortably there's no profit from a lot of tech companies that are getting hammered at the moment. The non-profit tech sector is down something like 70% since the beginning of February. But actually, charity is core to Islam, but certainly Sharia investments can make a profit, and it's our job to pick the ones that do. You can't profit from conning people. You can't profit from making something out of nothing or making money out of money, but there has to be a proper asset behind it. And you can't sort of lend to people at extortionate rates, but you can profit for everybody doing work if the money has been earned. So I think that's basically in line with a lot of environmental, social, and governance principles. Another complaint is that it's a performance drag. If I invest in an Islamic fund, I won't get a performance in line with its conventional equivalent. Well, actually, in the case of the Aberdeen Standard Islamic World Equity Fund, for the past 3 years, our fund has outperformed the conventional fund for a long time. That cannot be guaranteed in the future, and there have been times before the 2007 market crash when just about 42% of the earnings of the US market came from the finance sector. Even companies involved in engineering, like General Electric, got most of their income from lending to people. So if that happens, then maybe Islamic funds might fall behind. But I think we found out with the global financial crisis that a lot of that lending was pretty unprincipled, and there were misaligned lending to people who couldn't afford to pay back. And that's a trap that if you invest along Sharia lines, you're not going to fall into. And another complaint is it's just too complicated. I agree that some of the structures of a sukuk and the way that the income from a core asset can be calculated as profit sharing can be quite complicated, and there's a lot of complicated Islamic words used in describing them. But basically, Sharia screening can be put into two different classifications. The first one is excluding companies involved in alcohol, gambling, weapons, porn, and tobacco. And the other one is removing companies that have too much debt and sometimes too much cash. So basically what you're left with is quite a high quality portfolio. So that's debunking some of the myths. And another thing I just wanted to say is that, if you'll allow me, Jason, I don't know what the next question is you want to fire at me. If we could go to the next slide. Please go ahead, Jason.
Okay, you mentioned about sukuk. So I think there's a general lack of awareness or understanding about how Islamic finance works. Could you elaborate more about these Islamic principles in terms of Islamic finance that may apply to both Muslims and non-Muslim investors?
Well, I think working for a Scottish company whose board of directors no more than 20 years ago were all Presbyterian Christians, I'm in quite a good position to explain how Islamic principles actually work for people who are not Muslim. And I don't think that Aberdeen, they're not irreligious, but they're not a particularly religious bunch of people. There are many different religions that people practice within Islam, but we have learned through sometimes bitter experience that a lot of the principles of Islam are pretty immutable rules that benefit from following closely. I mentioned before, you can't make money out of money. That's called riba. Yep. Okay, and capital must have a social and ethical purpose beyond pure return. And that's a key rule that I think applies to a fund manager like Aberdeen as it does to anybody else. Speculation or gambling, it's not really our style. There's many ways of skinning a cat. There's many ways of trading markets. A lot of people are obsessed with people covering back their short position, delta hedging, and trading immediately after the announcement of data, etc. And that is one way to make money. But it is speculative. It involves massive risks, and we tend to look over a much longer term. And if you're obsessed with just these little movements in very technical and sometimes electronic nanosecond trades, then I think that that's really not what investment is about from our point of view, and nor is it. It's basically speculation or maisir, gambling according to Islamic finance. Gharar, which is quite hard to pronounce without bringing up quite a lot of phlegm, is basically you can't obfuscate the underlying asset of what you're offering. You can't con people into saying that something isn't what it is. There must be an underlying asset behind everything, and the information must be easily accessible to all. I think that applies to investment, and we've learned on a number of occasions that leaps of faith in assets and taking the word of management that you're not that familiar with is not a very good way to invest, and Islamic compliant investing prevents that. There is profit and loss sharing in various degrees according to the type of package, but as far as Islamic investment in equities is concerned, there's an underlying altruism and cooperation that actually is becoming very much what modern investing is about. It used to be just the shareholders that a company would be worried about, but now it's the suppliers, your staff, your stakeholders, the regulators, the community. So really, I think that the world is coming around to the way Sharia or the Quran dictated how investment should be. There are still bans on alcohol, gambling, drugs, pornography and other such activities. And I think in the past, I mean, there have been various brothels that are listed in Australia and the UK and the US. I seem to remember one called the Chicken Ranch. It might work for a while, but these things never tend to work over the long term, and we're long-term investors. So we basically don't get ourselves involved in that type of activity anyway. It's too difficult. So it's not really on moral grounds and saying we're a bit atas and a bit above it. It's just that it's difficult to make money out of those things. And as I mentioned before, there has to be a tangible asset behind every Islamic investment, whether it's suk or equity, and it has to be clear to everybody. And governance. We have checks and balances provided by our own compliance team, our Sharia compliance team, but also our Sharia advisors. So even if we want to play fast and loose, our compliance officers or our external Sharia advisors, Amani Capital, will make sure that we don't do that.
So you mentioned, yeah, sorry.
Yes. No, that's it. Sorry.
That's it. Okay. So you mentioned that you have an oversight body that sort of monitors whether your portfolios are adhering to the Islamic principles. What happens if an investment becomes non-compliant?
Right. This often happens that a company might take out extra debt to go into a new business and might exceed the ceiling debt level, whereupon on review the index provider like MSCI in the case of the Aberdeen Islamic World Equity Fund, or our Sharia advisor, which is appraised regularly in every quarterly report of what each one of the companies that are in our portfolio does, will remove that company from its list of approved investments. However, if the investment is in the portfolio and is at a price below the price at which we bought, you don't have to cut your loss. You can wait until the accrued dividends come up to the level at which your book cost and make your exit in that way. Similarly, if you have to exit a stock and it's at a premium to the price at which you bought it, so you make a profit from it, if you lock it in immediately, that accrues to the fund. If the profit accrues after the stock is removed from the index, the money goes to charity, or Baitul Mal in the case of Malaysia. So our Sharia advisor, in cooperation with the MSCI, who provide our list of eligible securities, make sure that we stay on the straight and narrow.
Would you be able to detect before this investment or this stock becomes non-compliant? Would you be able to detect ahead of the official conversion or some recategorization?
Yes, not every time. If there's suddenly a cash call that, or suddenly the company gears up and borrows money that's in excess of what the limit is, that can be immediate. But quite often the signs are there, and because we visit companies twice a year that are in our portfolios, and we look at quarterly reports and we engage with the management of the companies, we work with them to try and ensure that they don't exceed the limits that will throw them out of the index. And in Malaysia, but also all over the world, this is possible to do. There are companies that go into the index at the beginning of the year. Then when the Christmas sales come, like a lot of supermarkets, the alcohol element of their sales goes above a certain limit and they fall out. We try and avoid those stocks. Otherwise, you'll have stocks going in and out of the portfolio. Yep. But there is as much an art as a science towards managing these funds.
Thanks, Jerry. Definitely, we have learned a lot about Sharia investing and also debunked some of the common myths. Definitely, we have learned a lot there. Next, would you like to move on to the Aberdeen Islamic World Equity Fund and talk a bit about why it's suitable for investors looking for Shariah-compliant investments?
It would give me great pleasure, Jason, to do just that. We try and sort of define the advantages of the Aberdeen Islamic World Equity Fund by, the 3 R's: returns, research, and risk. Returns is probably the easiest one. And if you go to the next slide, why invest in global equities? This is the FTSE Bursa Malaysia IMAS Sharia Index, measured against the all countries World Islamic Index of the MSCI. And actually, you've seen, and this does not mean that it'll happen in the future. And in fact, since this chart was created, there's been quite a lot given back by the World Index. But we have had an average annual return of 13% from the Islamic World Index, whereas if you look at the FTSE Bursa Malaysia IMAS Index, it's barely moved. Malaysia has been a very depressing market since the global financial crisis. I'm not saying that will continue in the future, but it has been worthwhile to diversify out of the index for this simple reason. The other R would be research. And Aberdeen spends an inordinate amount of its revenues and in paying people to carry out this research. We're bottom-up fund managers, as I said, and it involves traveling around the world, visiting companies. If you start with sustainable competitive advantage at 1 o'clock in this diagram, our main intention as a long-term investor is to ensure that a company has at least 3 years of growth and that it has a brand or a business that has a competitive advantage over others. That there are plenty around, not that many, but there are plenty there, but you need people to go and find out about them, and you need people to visit them after you've made the investment to make sure that they're still got that competitive advantage. We like to forecast, without using any very complex formulae, predictable growth at 3 o'clock. And we have a large top-down macroeconomics team, Aberdeen Investment Institute, which in Aberdeen Research Institute that looks at the way the world is evolving and what sectors might be particularly beneficial, or what asset classes are particularly beneficial. So we have a top-down view as well. Earnings resilience, it sort of comes with competitive advantage, but if you're a brand leader, you tend to be able to raise your prices despite to pass on increased costs, and that's been borne out particularly over the past 4 months of this year. Return on capital. So for the money that you've got, you want to try and maximize the return, keep your costs lean, not too lean, and to be able to innovate. But good financial control is an extremely important factor, and getting a return on that capital is key. Balance sheet strength. We like to have companies that are slightly cash rich, and we like to invest in companies that if they have excess free cash flow, i.e. they generate cash over the year that is in excess of their need for expenditure, then they pay it out as dividends. So we get a decent dividend yield from a lot of our companies. We look at management very closely. This wouldn't be possible if you just read research from other broking houses. If you have your own fund managers who have their own investment process, you can get real-time information and actually beat the index providers in finding out those companies that have got the best management. It enables us also to have a concentrated positions in stocks. So we only have 40 odd stocks in any one global world equity portfolio, whereas other fund managers might stuff a lot more in the hope that some of them will do well. We have greater conviction in being able to invest in a smaller portfolio of stocks. Every fund manager, investment manager, owns a selection of stocks, and that selection of stocks has to be visited twice yearly, and they have to be scored according to 3 criteria. quality, value, and an ESG score. So we want to make sure that the company does have that competitive advantage, and we're confident of the long-term growth in earnings and strengthened balance sheet. We want to make sure that we buy it when it's offering very good future value, so it's significantly undervalued. And we want to make sure that the management is aware of the risks of a changing world, and that they're not going to get stranded investing in, coal-fired power, etc., that might actually be phased out. So they have to be aware of the risks and opportunities offered by climate change and the rules that are going to change between now and at least 2050. Otherwise, you could end up with an asset that falls to zero. ESG is environmental concerns, which is largely climate change. We've invested a lot to make sure that we see the company's plans to develop in line with the way we think the world's going to go as far as attempts to reduce temperature or temperature rises are concerned. Social is the S, and you might think that it was back in Victorian times when 8-year-old kids were forced up chimneys to sweep out the soot, etc. But we've learned to our cost in Malaysia that modern slavery is alive and well, and people are watching. So we make great efforts to make sure that the companies we invest in treat their people right. And governance is something that we've always done. We believe that management must be transparent, they must be honest, and they're going to tell you what they're going to do. We don't want to invest in a company that suddenly moves from making semiconductors to developing condominiums in Georgetown, Penang. So these are very key factors that I think are ideal for investing in a global portfolio. Some of the funds that Aberdeen invest in, or some of the companies that we invest in, they're all very familiar names. I think at least Adobe, Pfizer, Nike, Procter & Gamble, L'Oreal, Lululemon. I often wonder how many people who wear these Lycra stuff that Lululemon make actually have seen the inside of a gym. But I'm a cynic, and I confess I'm never going to wear Lycra unless I'm paid. But ASML is a company, if you look at the next page, as an example of, it's basically a Dutch, oh, sorry, I can talk about that a bit later, actually. I've come to the last R, and that is, how do we manage risks? Well, we have all sorts of quantitative equipment to look at how our portfolio stacks up against the benchmark, and where our risks are, where we're underinvested in sectors, and the stocks that we have in each sector, how much, if that sector goes up 10%, how much historically the stocks that we own in that sector go up. But really, in simple terms, if you look at the next slide, it's diversification according to sector and according to geography. You can do this in a country fund, but you have far greater opportunity to invest in the best in each sector if you invest globally like we do. And geographically as well, you might think, oh, goodness me, 34.4% of your portfolio is in the United States. Well, the actual benchmark weight of the United States in the MSCI Islamic All Country Index is nearer 50%. So we're actually underweight the US, but we think the S&P 500 is a little bit too biased towards being the S&P 5. The key stocks account for far too much weight. And in fact, if you invested in the US according to its benchmark weight, it would be unwise and not diversifying your risk sufficiently. So we have decided, for the time being, and it's a living thing, constantly changing, that the ratio of the countries that we have invested are as shown in this slide. So that's really the main way in which we manage risk. On the next slide, we like to have a mixture of stocks that benefit from growth, maybe a bit more expensive, maybe using a lot of their free cash flow to invest in new technology, and defensive stocks that are maybe more established brands, clearer business model, and have excess cash to pay out in the form of dividends. Of late, it's the growth stocks that have been hit quite hard, that have skewed our portfolio a little bit in the first 4 months of the year. But I don't think that the story's over for growth stocks. So we're constantly visiting these companies, constantly adjusting our weights. But it's that mixture of high conviction growth stocks and high conviction defensive stocks that makes our portfolio more resilient, we believe. And finally, we come to the result. If you look at the performance of the Islamic World Equity Fund, it's been going since 2013, so that's coming up for 10 years, 9 years. Since inception, we are still marginally behind the benchmark. The benchmark has gone up 12.26% per annum, as opposed to 1.3% per annum for Malaysian equities, which is the beauty of diversification. We have not kept in step with that. We're 79 basis points or 0.79% behind that on an annualized basis. I would add that 2019, 2020, and 2021 have all been very good years for us. And we've beaten the benchmark by a large measure over that period of time, as we have over a 5-year period as well. So, we have now an established team of very experienced fund managers, 14 of them who have been in the business for, between 3 and 30 years. So I feel very confident that with the help of others, our portfolio will outperform. The next slide looks at some of the types of stocks that we have in the portfolio. I won't go on at length about any of them. I think you're probably quite familiar with most of them. ASML, I mentioned, is a company that's based in Holland, but most of its revenues come from Asia, as it basically designs the codes for semiconductor boards. Cochlear is a brilliant Australian company that basically provides inbuilt hearing aids that have improved people's lives massively and still has a massive competitive advantage against others. And Dechra Pharmaceuticals is an animal pharmaceutical company that is the world leader. Linde, there used to be a subsidiary of Linde in Malaysia called Malaysian Oxygen, MOX. But that's the largest industrial gases company in the world that is servicing everything from power stations to semiconductor wafer fabs. On the next slide, just a few examples of, say, a growth stock, such as ASML, that is performed significantly above the world index, and we are confident that they will continue to do so and that their competitive advantage remains established. And the world of property development is changing. If you look at the next slide, we've held for a long time a company called Goodman Group. It's an Australian listed company that's investing all over the world in logistics, industrial and business parks. And these particular areas of the world are undergoing radical change at the moment. What was state of the art 10 years ago is now obsolete. And Goodman, we believe, have a particular vision as to the way that the supply chain is adjusting, what with US falling out with China, and China maybe getting closer to Russia, who just about everybody else has fallen out with. We're in a time of high flux, and Goodman is a company that we believe gives the best exposure to these particular subsectors of the property market. So that's really a little description of Aberdeen Standard Islamic World Equity Fund. It's a living thing, as I say, but at the moment we're well diversified. We have sections of the portfolio that is suffering as a result of the massive hit in growth stocks. But if you will bear with me, I can just give a little bit of an outlook on how long, of how we think the world might go. Would that be okay?
Yes, definitely.
Thank you, Jason.
We'd like to hear from you about the global equity.
Well, I've only got 7 minutes, so I'll be as quick as I can. And you've all seen, or maybe you haven't, but people of my generation, if you look at the first slide, familiar with Wile E. Coyote and his attempts, always unsuccessfully, to catch a roadrunner. And there comes an occasion when he runs off the edge of a cliff and he keeps going, and then suddenly he realizes that gravity has beaten him. The ground isn't there anymore, and he falls. And so I've just said here, have we come to another Wile E. Coyote moment? I think we have, because I think we have now got a regime change in the way the world works. And if I can just tell a little story, if we go to the next slide, we've had a lot of major shocks since 2000 and a lot of heavy falls in the market since then, as the world evolves quite quickly. But I think in the developed world, that's not Malaysia, that's really the US, the UK, Europe, and Japan. These markets have relied increasingly on central banks to solve their economic woes. And the central banks have used two tools: bring interest rates down to as low as possible, and a thing called quantitative easing. It's a long word that nobody had ever heard of till Ben Bernanke mentioned it, but it works a little bit like this. The government issues bonds, like the US government would issue US treasuries. Those bonds are auctioned off to the primary dealers, the private banks who buy them. Then the US Federal Reserve or the European Central Bank or the Bank of England or the Bank of Japan will go into the market and buy those bonds off the primary dealers for cash. The cash that they've used to pay for these bonds is printed. It's not really real money. It's creating money. And that money then goes into the reserves of the banks. And the way it's worked is that these reserves of the banks haven't really gone to the ordinary man in the street. Maybe there's been some mortgage growth, but most of that money has gone into asset classes. There's been those who have assets have been able to borrow, and banks since 2000 have been a little bit conservative in the developed world and will only lend to people who they think they're sure will give their money back. Anybody who really needs the money, they won't lend to. So all this money has been accumulating in banks' reserves, and it's driven all the equity and bond markets and a lot of other assets like private equity, like real estate, like wines, higher. But this increase in central bank reserves in the developed world has not led, until very recently, to inflation, because it hasn't led to an increase in consumer prices or consumer services, because it's not the ordinary guy in the street that's been able to take advantage of this largesse from the government. It's been the rich. And there has been this widening gap between the rich and the poor that's led to, a lot of social ills. We've all seen, I don't think you can blame it all on Donald Trump, but, the US seems to be divided amongst those who are basically xenophobic and want to keep things as they were, and those that are maybe too far the other way and are just hostile against the others. And a lot of the hostile people tend to be the younger generation who don't have a share of the wealth. So this is the problem we're in now. Then COVID came. And if you look at the next slide, sorry, just to demonstrate in this slide that this surge in liquidity, this quantitative easing and easy access to the money for those who are rich and those who the banks are confident will be able to pay back their debt, has led to private sector financial assets in the US to be 630% of the GDP of the country, which is, well, it's verging on obscene, really. And if you look at the next slide, I just want to show that one way of benefiting from this printing of money is just to buy equities. Whether they're good equities or bad equities, just buy the big liquid equities in the S&P 500, and you will have benefited from the increase in the Fed balance sheet. And the light blue line is the Fed balance sheet. The darker blue line is the S&P 500. And it's almost, well, not lockstep all the way, but at the end of 19 years, give or take a few trillion, it's about the same. But you probably see that the Fed balance sheet has increased by $8 trillion over that period. And it really, I think, has not benefited the right people. When The real acceleration came when COVID arrived. The central banks changed their tactics a bit, and they decided to pay money straight into ordinary people's accounts. Rather than this money going into banks, which then go to benefit the rich, this money was paid directly into people's accounts, and they spent this money on goods and services, leading to this increase in inflation. So now, for the first time since QE started, we have got inflation. And inflation is a bad thing. There's a guy called Russell Napier who's saying that if you're retired and you have your money in a bank account, and the bank account pays 2% interest and inflation is 6%, you're losing money. And he described this as the government taking money away from old people bit by bit, which is a rather nasty phrase. But in fact, even Vladimir Lenin said in 1917, the way to crush the bourgeoisie is to grind them between the twin millstones of taxation and inflation. So basically, inflation is another tax that you're already paying tax to the government, but inflation is something that really has to be removed. And if you want to remove it, you've got to raise interest rates. You've got to take away some of this money. And if you look at the next slide, it just shows how this has started already. Although the government hasn't started tightening liquidity, the markets have anticipated this is going to happen. You've probably heard the central banks of the developed world all saying that interest rates have got to rise, inflation is a threat, we've got to take away some of the liquidity that's there. And so the biggest fallers have been those stocks that are big, liquid, and nobody's really been worried what they're worth. So they've been falling very heavily. If you move on to the next slide, you can see that just to show how stupid things have got, the whole market capitalization of ASEAN is $645 billion US. Well, at the end of February, Tesla was $900 billion. Apple was 2.76 trillion. So, more than 3 times, nearly 4 times the market cap of ASEAN. Now, Apple is a great company. Everybody's got mobile phones, but that, I think you might agree, is seriously out of kilter, and it might fall further. Well, there have been some huge falls. I've just done the math on it, and from its peak, Netflix has fallen 77%. Meta, or the old Facebook, has fallen 43%. Tesla's fallen 28%. Amazon's down 30%. Alphabet's down 23%. Apple's actually only down 15%. The valuations are starting to get a little bit more like sensible. Netflix is on 16 times next year's earnings. Meta is on 17 times. Tesla's on 66 times this year's earnings. It was 106 times last year's earnings, but it's growing fast. Amazon's on 35 times. Alphabet's on 20 times, but not growing that much. Apple's not really growing at all, but it's on 25 times. I think we're getting nearer to a price that's starting to look reasonable. This is the key thing I want to say about the outlook for the market, and that is, despite what the central banks of the developed world are saying about raising interest rates, taking away the punch bowl, reducing liquidity, they're not going to be man enough, they're not going to be brave enough to do it. And as soon as markets correct by much more, I think, and if the economy starts to slow, and if you look at the next slide, there's some estimates of what GDP is going to do over the next few years for the world. I think that we're actually going to see the Federal Reserve, the European Central Bank, the Bank of England, the Bank of Japan chicken out of this hawkish talk, and we'll be back to low interest rates. We'll be back to extra liquidity coming to the market. Already Boris Johnson's talking about, he's already lent money to Land Rover free of charge. Joe Biden's already talking about spraying money at individuals because of higher petroleum costs. Macron in France, who's just elected, is starting talking about lending at no interest rates and guaranteed loans to industry. We've got plans to convert the whole of the world to be more protected against its dependence on Russia and China. We've got to convert from gas, fossil fuel power to renewable energy. This is going to take trillions. So I think we will return to this era of mad money. and the markets will go up again. So keep your eye on these big growth stocks, and their falls have been dramatic. There may be a bit more downside, maybe they'll overshoot, but to have a portfolio of purely defensive stocks without any growth stocks is not wise. And we continue to have a mixed portfolio. We've also got, the Ukraine conflict, and it's very hard to forecast the effect of that. But I think, in summary, what you need, and I'm saying in summary because looking at my watch, I've already overshot my time. You need to have a diversified portfolio, and a global equity portfolio managed by one of the largest bottom-up stock picking fund managers in the world is the way you should go. Why Aberdeen? I think we're a fund manager for all weathers because we're familiar with growth, we're familiar with defensive. We look at stocks all the time with our investment professionals all over the world, and it's all assessed from an ESG point of view, every single stock. And the diversified returns and the risk diversification you're getting from the Islamic World Equity Fund is second to none, and probably why iFast have rated it as the top Islamic Global Equity Fund for 5 years running. And that's it from me. If there's any questions, I'm happy to answer them. If there aren't, I'm happy to go and have my supper.
We do have some questions from our viewers. Perhaps talk a bit more about the performance of the fund during 2019 to 2021. What were the key drivers of the performance? And I noticed that this year to date, it has underperformed the benchmark. Perhaps you could talk a bit more about the detractors also.
Okay, well, I think what helped us in that period between 2019 and 2021 was a slight change in style. We have given more freedom to individual portfolio managers. This particular fund has a portfolio manager in charge, and he is allowed to vary from our standard portfolio in order to meet the needs of the unit holders of that unit trust. And we believe that in the interests of diversification, you should have exposure to not just the defensive stocks, but have a smattering of good quality growth stocks bought at reasonable prices. But reasonable prices for growth stocks, because they need more funds to invest in their growth, tend to be at slightly higher valuations. So it is that mix that I think has led to the outperformance, and probably selectively avoiding the areas that have caught other people out. Some people might have got overexposed to fossil fuels, overexposed to oil and gas companies when they were big index heavyweights, or exposed to these no profit but high growth stocks whose revenues are going through the roof, but whose earnings have not happened yet. And we saw back in 1999 when Aberdeen found it very difficult to persuade clients that a lot of these high growth stocks that are not making money are never going to make money. You can have growth in revenues and you undercut your competitors to grow market share if you've got banks that are willing to fund it. But all you need is a change in global conditions, and banks aren't willing to lend to you anymore. So we have to keep our portfolio sensible, which I think led to that period of outperformance in the 3 years up to 2021. This year has been difficult, and a lot of our growth stocks have been hit disproportionately hard. We are adjusting, and of course we are depending more on some of our dividend-paying stocks. So I don't think the story is over, and we will recoup the underperformance. I would just highlight that even though we have underperformed the benchmark has outperformed most of the world's benchmarks apart from NASDAQ. And NASDAQ has had a nightmare of 4 months in 2022. In fact, bonds and equities together have been hit hard. Even gold has been hit hard. Bitcoin has been hit hard. Just about everything at the moment is having a hard time. So it's difficult to find where to put your money in safety. And we refer to our macro team to tell us how we think the world might evolve. But I think slower economic growth is one. I think capitulation of the central banks of the developed world, and they'll start to increase liquidity and reduce interest rates again, is the only way we're going to get through this. And in that case, being out of growth stocks would be a not a good move. So we believe we've got all positions cornered. And please bear with us as we go through a particularly difficult beginning to this year.
Is the fund manager adjusting the portfolio based on the macro changes, such as rising inflation and also rising interest rates?
Yes. We had almost zero exposure to Russia, which was a boon, because we valued every Russian investment we have. It hit our global emerging market funds much harder. But Russia is something like 1.5% of a global index. And anything invested in Russia, we have marked down to zero. It's not really tradable. So we've invested in those economies where we think growth will continue irrespective of relations between Russia, US, China. It's a very complicated world. I can't help feeling, I showed a chart earlier to show that the real fall guy over the past 4 or 5 years has been ASEAN. Southeast Asia is a population of 660 million people. Foreigners just about sold out of it. The price earnings ratio on average for the ASEAN markets is about 11.5 to 12 times. Earnings per share is not great at 3.9% for this year, but I think that we've got no further to fall. I think emerging markets, particularly Asian emerging markets, are areas that are of great interest. I'm not going to advise the team in Scotland how they will manage things, but I'm sure they're aware on a valuation basis how much upside there is for a lot of the emerging market, Asian emerging market investments.
Thanks. Knowing that the fund only has 41 stocks, would the concentration risk per company be high?
Well, concentration risk is one way of looking at it. I suppose high conviction is another. We've got all these fund managers dotted all over the world that are visiting companies at regular intervals, and they will grade what they see, looking at valuations, looking at quality, looking at the ESG, and looking at how they fit in. Or the global team will look at how these investments will fit into the overall portfolio to diversify the risk. So that's a living thing that's changing very regularly. And the key is, I think, to communicate with everybody. We have won a number of global mandates here in Malaysia because we're very close to the global team, global emerging market equity team, the global fixed income team. Everybody talks to each other. And we have these people with extraordinarily large brains in Scotland who bring out our macro view. Now, I may disagree with them, but they look at things in far more depth. So we have quite good hands on the tiller to navigate through this.
You mentioned about ESG being a key criteria for abrdn's strategy. How long has it been in a part of your strategy? Because
well, the
ESG,
G-bit, the G-bit really for the past 38 years, since we started as a pure fund management company in Aberdeen in 1983. Now, Aberdeen Standard Life Investments has got a rather longer history. They started in 1825. But the investment style of both has been bottom up. Governance has been an area where we've been particularly active. And this is our 30th year in Asia this year, actually. But the reason why Hugh Young went out from London to set up Aberdeen in Singapore and to invest in Asian companies is to be able to visit companies and find out that there's as much an art as a science to investing in companies, and to find out those managements that are honest, transparent, and not telling you lies. Generally, in Asia, a lot of companies are family controlled, okay? And there's a dominant family executive chairman in the past who has sort of moved his company in the direction that is a benefit to him and his family. That's a risk that we've worked very hard to avoid. There are other family-run companies that are run extremely well and for the benefit of shareholders, stakeholders, suppliers, and the community. So our skill there is governance has been going since, or at least for 38 years. Social issues are something that we're very painfully aware of here in Malaysia, but it basically appeared because Malaysia, I think, uses a lot more foreign labor, and they haven't been treating them right. And to be investing in some of these companies gives the fund manager a stigma, which you want to avoid. So we're very careful to make sure that the companies in which we invest observe the rules. However, I would add that in the case of Malaysia, sometimes the US CBP, the Border Protection Commission, tends to listen to NGOs without any evidence, and they will withhold export of the products of companies that have actually moved to meet the ILO and modern slavery rules. So I would say, actually, myself, Silent Derby Plantations is one of them, but that's not in our portfolio. That's just my own view. So things move very slowly sometimes because it's politically correct at the moment to ban things, even if the company they're accusing of committing them are not doing it. So social is very important. The environment, I think we all found out when that guy Ranulph Fiennes went to was it the North Pole or South Pole? But he came back and he showed inescapable evidence that the snow is melting in the poles, and that the ozone layer is starting to thin, and temperatures are rising, and the whole shape of the world could change. It is no longer disputable. I think not even Jeremy Clarkson, not even President Bolsonaro in Brazil is going to argue against that now. So we have to work out, for our children and our children's children, how to make sure that the world remains habitable. So this is a very high obligation, made all the more difficult by military confrontation in Ukraine and trade confrontation between China and the US. But I'm glad to see that Europe and the world has doubled down in order to try and shift sources of energy to renewable and to improve efficiencies. So if a company doesn't take into account the future risks and opportunity from climate change and the way the world is going to change and the rules will change, then you could be left with a stranded asset, an investment that goes to zero. And there's nothing as a Scotsman that people dislike more, and that's your investment to disappear to zero. So we're particularly ragin on that, and that has happened really since the turn of the century. We've invested very heavily in a sustainability team in Scotland, and then we have sustainability experts in each one of the continents where we invest, and each team, whether it's fixed income or equity, has a ESG specialist in that team to direct people if they have problems. So we have got a very good infrastructure. As a matter of interest, we're having a sustainability week from the 23rd to the 27th of May this year, in which we will be debating these things. If anybody wants to attend it, please contact us, and people will be able to listen in. But it coincides with our 30th anniversary. That the environmental side of our analysis really started at the turn of the century and has accelerated really since 2010.
That's great. That's great. Would you be registering this fund as an SRI fund with the SC in the near future, because you have all these ESG methodologies in your stock selection?
We do integrate ESG in every one of our investments through all of our equity and fixed income and real estate investment teams. But I think there are various rules that are set up by the European Union, by the regulators in Malaysia, like the SC, that might preclude us from saying ours is a green fund. There's various versions of green fund, that none of our investments, that they all have to meet a minimum ESG score that our analyst for every single company owns. If it falls below that level, it's not investable. So they are ESG aware, and all of our investments meet those criteria. But then it's not an impact fund. We can't measure precisely the amount of carbon dioxide that is recycled by each company. We're working towards it, but it's still a work in progress. And until that happens, I don't think we'll be able to, put a stamp on it saying this is World Wildlife Fund approved, ESG compliant.
We're running out of time. Let's have one last question, if you don't mind. So you mentioned that Shariah-compliant equities, they tend to have lower debt or lower leverage, lower debt to equity. Would they be less susceptible in a rising rate environment? Would they do better going forward? Because they
Good point.
Yeah,
good point. I mean, to be honest, the way debt works along Sharia rules means it's profit sharing, and interest rates are the current conventional interest rate is reflected in Islamic investments as well. So yes, gearing cannot be above 30%, or debt cannot be more than 30% after the cash holdings of the company's market capitalization. So in practice, next to an overgeared company, yes, they could be beneficiaries. I would just add, though, after this massive fear of escalating interest rates and the reduction of liquidity, I think maybe, who knows, by the end of the year, all these central banks are going to change their tune a little bit, and we might get interest rates peaking. It all depends how inflation pans out.
Thanks, Jerry. That was a very fruitful session for me, and I'm pretty sure our investors or our viewers will also agree. I think that's all the time we have for today. Before we end, I would like to remind our viewers that we still have a promotion ongoing for this fund that we mentioned today, the Aberdeen Islamic World Equity Fund. There's a promotion that runs until the end of the month, so do check it out. That's all we have for today. Thank you for joining us. Thanks, Jerry. Definitely very great to have you here with us today.
It's been a pleasure, Jason. Thank you very much, and everyone at FSMOne.
Thank you.